The most common one is they do need more sales. Yeah. But then there's the other category of business owners where even if they get more sales, they're still going to have cash flow issues.
Yeah. I can see the whole wide world with these two eyes, and I can be whoever I want to be, 'cause it's my life.
Hi, thanks for joining us for another episode of Ask Spurrell CPA. Today as the Edmonton Business Coach, we're talking about how revenue won't fix a broken business model. Again, as the Edmonton Business Coach, we're talking about how revenue won't fix a broken business model. We have Denise here with us. Denise, how has the content been going on the Always Bookkeeping side? What's the weekly content?
Really good. We're doing good. Yeah.
Getting the videos out the door weekly?
We are.
Right on.
Yeah, it's always a struggle.
Yeah.
I think we hear that from a lot of clients, right?
Mm-hmm.
That's a really hard thing to do when you're not used to it.
Yep.
But yeah, we're getting it there.
Can be done.
So it can be, yeah.
The quote that we have here today is a Warren Buffett quote, all-time great investor. Accounting is the language of business. And the statistic that we have is 50% of all Canadian businesses go out of business in the first 5 years, and 29% of these failed businesses will list running out of cash as one of the primary reasons for their business failure, making it the second most common reason. Running out of cash is the second most common reason that businesses go out of business. And the story that we have here, we have business owners, they're experiencing a cash crunch, and they think more sales is the answer. So Denise, what are the questions that you think these business owners should be asking?
Yeah, so do entrepreneurs often focus too heavily on expenses rather than on sales?
Yeah, so generally it is the problem. I mean, a lot of times business owners, they're looking at, how to fix their business. They have cash crunch, they can't pay the bills, and they're thinking too heavily on, hey, we need to minimize expenses. We need to minimize expenses, when really they don't have enough sales for it to be meaningful at all anyway. So there are a lot of entrepreneurs who do focus too heavily on reducing expenses rather than spending their finite amounts of time on increasing sales. So it is a common problem, yes.
Will some businesses continue to have cash flow issues even with more sales?
That's right. But then there's the time where even if they do focus on the sales, there's something fundamentally wrong in the business that even if they do increase the sales, they grow the sales by 10%, 20%, 50%, or even 100%, they're still going to have cash flow problems. And we run into them again. So there is that balance between, there's a lot of business owners. I would say the most common one is they do need more sales. Yeah. But then there's the other category of business owners where even if they get more sales, they're still going to have cash flow issues.
So Josh, what is gross margin? So
the gross margin is really, it's the gross profits after you pay for the direct cost of the product or service that you're offering. So I mean, if you're a plumbing contractor, your gross profit is really, your revenue less your cost of supplies, less your subcontractors use, less your labor that was actually used on site, the cost of the guys that were on site. If you're a dentist, it's your revenue less the cost of the hygienists and associate dentists, less the cost of the lab fees. That is the gross margin. Before we get into any overhead expenses, the rent, the insurance, the accounting, the interest and bank charges, it's the gross margin just from those costs that are directly correlated to generating more revenue. They go up and down directly with that revenue. That's the gross margin.
So why is it important to understand the gross margin? It's
important to understand the gross margin because if there is no gross margin, it doesn't matter how much work that you're going to do, you're always going to have a cash flow problem. We run into it, especially with a lot of construction companies that they think, yeah, they get a deposit in from the job and the cash flow is good, but it doesn't matter. By the time they get to the end of the job, they're losing money on the job, or the margins are so thin on the job that there's nothing going to be left over at all. So it's really important to understand that gross margin, because if we don't have the right gross margin, it doesn't matter how much we sell, we're never going to have enough money for this to matter.
Okay. So can large businesses survive with thin margins?
Yeah, large businesses can survive with these, razor thin margins. We see it in big construction companies, big restaurants, they're single digit gross margin numbers. But you know, gross margin, if you have 5% gross margin on $100 million, that's, you know, that's $5 million in gross margin. But most of the businesses we're dealing with, you know, they don't have that. So large businesses, though, they can survive on these razor thin margins for sure, and they can make really good money and great returns to their shareholders. It's certainly possible.
Will small businesses generally survive if their gross margin is less than 15%?
Generally, that's the number I throw at people, and you know, it's not a catch-all number, but I can just tell people from my experience with businesses that have less than $10 million in revenue, I have not seen a single business survive with, you know, survive well. I don't mean, you know, just barely get by. I mean where the business is thriving and the owner is making reasonable profits. I have not seen one single business, you know, in my 2 decades of working with small businesses, I haven't seen one work well with less than 15% gross margin across every single industry we've dealt with. Right. It just tends to be, you know, too little of that gross margin. You know, they can never overcome their overhead expenses. There's always overhead expenses, although they're not directly related to the job. You know, they do go up the bigger the business gets. So, you know, the problem is, you know, a lot of these business owners, they start looking up what the big construction guys have. You know, you're a general contractor, you find out that PCL is making 4% on it, and they think that they can make 4% on a job. It's never going to work. You know, the gross margin has to be significantly, it has to be higher in a small business because there's, you know, there's less economies of scale.
Right. So do customers often value complete and on time more than perfect?
Yeah, they will. I mean, that's one of the things. So we have to look at the things that we can do in the small business. You know, what are the differentiators that we can add to that gross margin? You know, the big guys will struggle because they're trying to capture such a large percentage of that market share. You know, but the small guys can be really differentiated and get them the exact solution that the customer wants, and they can get that increased margin for sure.
So are admin staff often a large component of the overhead expenses? Yeah,
generally when we get down to that, you know, we have that gross margin. Now we've established that we actually have the right gross margin, and it's a margin, you know, north of 15% or north of that we actually have a shot at. Now we have to go into the components of the overhead expenses, and generally we have to look at the admin staff, because for most small businesses, there's a couple of items in the overhead that matter, you know, significantly more. You know, the interest and bank charges and the phone expenses are never going to amount to much at all, but those admin staff are, you know, often one of the largest, if not the largest component of most small businesses in terms of what their overhead is. You know, after we make our gross profit margin, we have to pay these overhead expenses before we can pay ourselves, and that admin wages is going to be one of the more significant ones.
Yeah. So is the physical location of the business often a large part of overhead?
Yeah, next to the you know, the admin staff, it's generally the physical location. So whether that's the lease that they're locked into, or whether that's the interest on long-term debt and the principal payment on the long-term debt of the mortgage of the place that they're locked into, the physical space that the business operates out of itself, you know, if it's not a home business, is generally one of the largest components of that overhead expense. And, you know, it's going to be one of the most significant numbers that we have to make sure we have enough gross margin to overcome that.
How long does it take to double the size of a small business?
Yeah, so a lot of business owners, they come in and they have these, okay, they start working out what their margin is and what their overhead expenses are. They know what their admin staff is and what their, you know, their rent is, and they start to think, okay, you know, let's double the revenue. It's been my experience that the absolute outliers are the people who are going to double their revenue. We're talking, you know, the 20% of businesses and 10% of businesses who are successful. We're not just talking about the, you know, we remember 50% of small businesses fail. Yeah. Now we start talking about the ones that are succeeding, maybe 10% of those. You know, if they're really in that growth phase and they really, you know, they got lightning in a bottle, they got something really good and it's really cooking. A double, you know, to go from 100,000 to 200,000 or 500,000 to $1 million, that's generally going to take at least a year. Like at least a year. Yeah.
Sorry, what if a business needs to double revenue to cover their overhead?
Yeah, so then they think about, okay, I'm just going to double it, and they act like, that's going to happen in a month or two. And they got to remember that even if they're that outlier, they're going to go from 250,000 to 500,000, that's going to take them a year. So if you need a year, to cover that overhead expense, if we needed to double revenue to cover overhead expenses, we have to plan that there's going to be a cash flow shortfall for an entire year, and what's going to be the source of working capital to overcome that. So generally, most businesses, they can't just say, hey, we're going to double that business, we're going to double that revenue to cover that overhead expense. A lot of times they're going to make some real key decisions and cut some of that overhead expense. They have to sublet some of that space, or not choose that space that's so big to begin with, or take some of that admin staff and either have to make the tough decision to lay them off or deploy that admin staff on something that you can bill for. So it's not just as simple as saying, hey, we're going to double revenue to cover that overhead expense. We have to have a realistic time projection to double that revenue. And the absolute outliers are the ones that are doubling revenue in a year. So if you're planning on doubling revenues next month to cover that overhead, guess what? We're going to have a cash shortfall 999 times out of 1,000.
Yeah, right. So why is it important to review your numbers every 2 weeks once you have staff? So
once you have staff, you have those significant overhead expenditures. You have lots of times that staff is involved in the direct costs. So they're, involved in, they're going to determine what that profit margin is, that gross margin is. And they're also going to can be a component of the overhead expenses. So you really have to, drill into that every 2 weeks, because, for most small businesses, they're going to hit their marks sometimes and they're going to miss their marks. Other times they're going to spend too much time on projects, or they're not going to realize how significant those overhead expenses are. So once you have staff, I think it's really critical to review it every 2 weeks. And I say every 2 weeks is because most people pay their employees every 2 weeks. So you want to review, what's coming in and what's going out every 2 weeks to keep an eye on what those gross margins are and what those overhead expenses are, so they don't get out of hand. And that can be a bit of a turn from when you're a solopreneur. A lot of times a solopreneur can simply look through their bank statements at the end of the month, and they can look at their financial statements at the end of the year. And that a lot of times can give them enough information to move forward. But as soon as you have staff, those numbers can fluctuate wildly. And if you're not keeping an eye on them, if you're only looking at them once a year, I mean, the business can be out of business in that year. So looking at them every 2 weeks is probably the ideal once you start to have staff. So I think that's what we have here today. Thanks so much for tuning in. We look forward to any comments that you have, so we can respond back and use your feedback for future videos. As always, please hit that like and subscribe button so we can continue to deliver you tips on how to beat the odds of business. Thanks very much.